Lupin corrects as brokerages remain pessimistic over the company's ability to meet margin guidance. Delays over the launch of the Spiriva generic also add to concerns over revenue growth. Oil India surges after a strong third quarter. Profit surges despite windfall gains taxes. Brokerages, Motilal Oswal and ICICI Securities are bullish on the stock. Balkrishna Industries cracks after profits slumped 70% in an extremely weak quarter. City Union Bank also slips as asset quality worsens. Net interest margin comes in at a sixth-quarter low. Stock down 11%. A big block deal in Coforge sees almost 10% equity change hands. Sources say the promoter, Barings PE, is likely to have sold stake in the company. Shares of IDFC and TV today both fall after stocks go ex-dividend today. So it's not a fall, it's an adjustment. Hello and welcome. You're watching us here on Chartbusters on CNBC-TV18. We've seen a bit of a downtick at the start. A 100-point decline is what we've seen on the Nifty. The Nifty banked down about 0.5%. The mid-cap index, which outperformed all through last week, has taken a bit of a backseat today. More stocks declining than advancing. Where do we go from here is the big question. But until then, we have a bunch of corporates joining us today. Let's start with Metropolis Health. Reported a weak operational performance in the third quarter, with the revenue falling both year-on-year as well as a sequential basis. A large part of the decline also was on account of the non-growth or a big decline in the COVID-related portfolio. But ex of COVID, there has been a bit of growth. We do have with us Ameera Shah, who's the promoter and managing director of Metropolis Healthcare, joining in to discuss the quarter gone by, but more importantly, the outlook for the future. The stock doing well in today's trading session. Thanks a lot, Ameera, for joining in. Before we talk about numbers, etc., in November, we had the news of IT raids being conducted at your premises. Just wanted your thoughts on what was the outcome of that, and have you received any notice from them thereafter, before we talk about the numbers?
Hi, good morning. There was a search operation, as we informed and intimated SEBI, that happened in November. And as we informed, there were absolutely zero unaccounted assets seized by any tax department. In fact, this is the, I think, 8th company in healthcare which has had a search operation in the last 8 to 9 months. And if there's any up-to-date beyond that, we will be informing SEBI first, obviously. At this point of time, there has been no tax demand made.
Okay, all right. So pretty clear on that front. Ameera, thanks so much for clarifying on that. Let's focus on business then. For the past quarter, your margins were in the vicinity of around 25%. Give and take everything with pricing, with volumes, with higher cost. Where do you see that number headed? What's the band you'd like to guide?
So currently, if you look at it, if you keep aside COVID, because obviously COVID was there in the base year, which none of us can do much about. But we've seen a 20% growth year-on-year, excluding COVID, as a part of our revenue growth. And I think investors, from what we hear, have been comfortable with that growth. Margin also we have sustained. Actually, if you look at the margin, there are two parts of it. One is the reported EBITDA. There is an operating EBITDA, and there's an EBITDA before sort of ESOP. But if you look at the operating EBITDA level, we are actually doing well. We've maintained our margins. This quarter, we've also come out at operating EBITDA level of 28%. We have had a dilution of about 1.3% because of new labs that we have started, and obviously which have added losses and not given immediate profits. But overall, we've been able to protect margins and be able to sustain margins, and we believe we can do so going forward as well.
Right. I just wanted two numbers from you in terms of thoughts, if you could guide the street. The first one is that you've been ramping up your stores and your reach. What is the contribution, the expected contribution from new network, which is currently about 3% of your sales? Secondly, premium wellness, which is about 13% of your sales, obviously has much better realization and margin metrics. 26 crores is what it did in the third quarter. What is its contribution likely to be going forward? So on new network contribution from 3%, where does it go? And the same for premium wellness, from 13%, where does it go?
So our goal is to move the wellness category closer to a sort of a 20% number, and over the next few years, and that's what we are moving towards. We've already seen it move from 10 to 13% from last quarter, last year to this year. So obviously that's an area that's growing for us. The new network, the new lab network, we had planned and given a goal of starting 90 new labs and 1,800 new centers in 4 years by 2025. We are well on track to do that. But obviously, what that means is short term, there is a dilution of some percentage of EBITDA. But we know that in 2 years after starting, those labs move into sort of a profit zone. So it's really about making those seeds of investment today and reaping them in the future. And we are continuing to do that and still being able to protect our margins on the more mature labs and collection centers.
All right, Ameera, what about realizations? I think they're in the vicinity of around 950 rupees odd. Where do you see that number headed?
So we've seen about 3% increase year on year on revenue per patient from last year, the same quarter. So again, I think we're very comfortable with the numbers and the KPI, the way it's tracking. I think we would hopefully continue to see as the product mix keeps changing and we keep moving up and up the value chain. As we know, Metropolis is respected as sort of the highest quality player in India in pathology, and therefore people want to send to us very complicated, advanced, specialized tests beyond the routine that they can trust their lives with. So as that product mix keeps increasing, we will see the RPT keeping on moving up.
All right, and final question before we let you go, Ameera. The last 8 or 9 quarters, every quarter has been marred by some sort of COVID-related disruption, etc., and as a result of which, it's had an impact on your numbers as well. But hoping and praying that the worst is behind us. Going forward, what's a sustainable growth rate that we can foresee for your business because of the triggers that you've spoken about, the drivers, increased stores, increased revenue coming in from the premium healthcare, etc. business as well, a lot of your new stores turning profitable. What's a sustainable growth rate and a targeted improvement in the margins per quarter going forward, adjusted for everything? What's your target?
So if we keep aside acquisition, we keep aside COVID, we keep aside even the government contracts, which tend to be in larger pieces, 9 months we've actually seen our core business grow at about the mid-teen level year on year. And I think, that's the historic trend, obviously, that we would like to continue into the next year as well and continue to protect margins as they are. So I think, we've had a challenging year from many aspects, lots of external threats. But I've seen Metropolis come out of all of that still, swinging and doing well. And I'm definitely confident that we will continue that into the next year.
And what do you mean by protect margins? I mean, 27% is the adjusted margin that you've reported. Going forward, there are triggers from new stores turning operationally profitable and higher contribution from the other businesses. So is there a case for margins to go higher and sustain around those 30% levels?
They were never 30% in the first place. If you look at pre-COVID, they were always at about 26, 27%. It was only during because of increased volumes that it went up to 30. And I think we were very categorical in saying that 30% is not the sustainable margin going forward. So I think if we compare to the pre-COVID margins, we're already there. And we would like to continue, like I said, to stabilize at these margins.
Okay, always a pleasure talking to you, Ameera. Thanks so much for stopping by and giving us your details on your results, the way ahead as well. Wishing you and your team all the best, with regard to financials as well as taking care of all of us. For the time being, though, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Rekha joins us of moneycontrol.com to tell us about a stock that they're tracking very, very closely. Rekha?
Yes, thanks. So we're turning positive on Sharda Cropchem. The company recently posted its December quarter results with a revenue growth of 16% year on year, driven by both volumes and better price mix. However, owing to the negative impact of euro depreciation against the US dollar, which declined about 13% in the first half of the fiscal and which has a lagging effect, led to higher input cost in the third quarter, thereby leading to a contraction in the gross and EBITDA margins. However, the recent euro to US dollar movement, which is up nearly 10% from its lows in September 22, suggests that currency headwinds for Sharda Crop is now a passé, meaning margin pressure should also abate in the near term. Also, with several molecules going off patent in the next few years and a good pipeline of registrations already in place, we think the company's agrochemical business volumes are likely to remain firm in the medium term. The company also remains confident of prices sustaining at current levels and thus reiterated its FY23 guidance. Now, given the favorable currency trend and a firm business outlook, we have raised our margin estimates for FY23 and FY24. That said, currency fluctuations should be carefully watched. Now, at current market price, the stock is trading at a PE of 11 times our FY24 projected earnings, which is much below its long-term historical averages. Now, with reasonable valuations on its side, we see enough headroom for the upside.
All right, Lekha, thanks a lot for that. With that, we'll simply a short break. On the other side, we'll be joined by the new listing. Shrikant Nadella, the whole-time director of KFin Technologies, joins in to discuss the company's third quarter earnings.
Welcome back. Well, the markets have taken some bit of a support at those lower levels, and now we're continuing to trade above that 17,750 odd mark. So good to see a bit of a bounce from the low point of the day. Well, let's focus on another company. KFin Technologies, well, their profit doubled on a year-on-year basis. Margins remain stable. To understand more about what's the outlook for the final quarter and FY24 as well, we're joined by Mr. Shrikant Nadella, the whole-time director and CEO of KFin Technologies. Hi, Shrikant. Thanks so much for joining in. Well, margins are moving towards the mid-40s odd. Could you give us a guidance about, where do you see this number headed? And also your AUM market share. That's been stable around 35%. Where do you see that one headed?
Certainly, Nigel. Very good morning. We continue to focus on the controllables, which is the costs, of course. The markets, tend to behave the way they would. Our margins have come closer to 40% for the 9 months, ending 31st December, even as our quarter EBITDA has moved up north of 43%. We believe that, the trajectory could be maintained into the coming quarter and into the subsequent quarters as well.
All right. You've said in the past that 20% growth is something that is sustainable with margins between 42 to 45%. Just wanted to know whether you are comfortable with that 20% growth in this year and the year after that as well, at least in the near term. And secondly, you had earmarked some amount for some sort of acquisition in organic growth as well. Where are you on that right now?
We've continued to expand our businesses through acquisitions of incidental and ancillary businesses. We have concluded and integrated a fund administration business into earlier part of the previous year. At any given point in time, we are scouting at least 3 to 4 acquisitions, all of which are on track at this point in time. In time to come, we should be able to make some announcements in that regard.
Right, and your margin, you said, would improve between 42 to 45% by when, and the 20% growth guidance, that stands, right?
Mangalam, so we are at 39.9%, for the 9 months ending 31st December. So we are close to 40% already. We believe that we'll be able to maintain the trajectory of 40 to 45%, subject only to the market performance. As you know, about 60% plus of our revenues are linked to the performance of the equity market. So, subject to any non-material changes, we'd be able to meet that. Overall revenue growth for the 9 month ending 31st December was about 17%. Again, there had been a patchy, NFOs on the equity markets, even as all other businesses of ours, issuer solutions and international business, has grown over 40% plus to give us a cushion to grow at 17% plus into the 9 months ending 31st December.
You mentioned growth a few times, Shrikant, out there. And international and other investor solutions business, well, on a low pace, that's growing pretty well. As a percentage of your total revenues, what do you see this ideal mix at? And if you could tell us a broad revenue trajectory, particularly of both these two segments.
Most certainly. We started the year with about 67% of the revenues to come from mutual funds. The share of the other businesses, albeit on a smaller basis, as I said, has grown over 40%, which got us to a percentage of little over 62% to come from mutual funds and the remaining to come from the non-mutual funds businesses. We are very purposeful in diversifying our business, even as the overall pie expands. The share of the pie that is contributed by the international as well as the issuer solutions and the other businesses, we believe, should get us to anywhere around 60-40 mix in the near term. When I'm talking about near term, it's about a year from now. But over 3 to 5 year trajectory, we'd like to believe that over 50% of our growth will come from the non-mutual fund business.
All right, 50% of the growth coming in from non-mutual fund business. The revenue potential of this deal that you've done in Canada for fund and administration services is what we want to know from you. And also the potential of business coming in from Gift City operations, because you've started that in Feb itself, right?
That is correct. We are very excited about our start of operations in Gift City. We have already won 6, funds in terms of 2 being international and 4 being Gift City domiciled funds. There is a pretty large pipeline which we hope to convert into the next month to 2. In terms of our Canadian deal, this is the very first time that we have moved to West. Otherwise, all our international operations are more gravitated towards Southeast Asia. The deal by itself is a small size deal at the moment, but something that we believe will open up doors into the broader fund administration markets of US and Canada.
All right. And, your market share has increased from 29% to 35-odd%. What is your target market share going forward? Because you're talking about growing faster?
See, our expansion in the domestic mutual funds was largely on the back of, a significant number of wins over the last 5 to 6 years. We continue to maintain a very healthy win rate of little over 65%. We won 15 out of the last 22 mandates. We manage 27 out of 41 operational asset management companies, even as our funds are mostly equity focused. Given the SIP book is quite substantial for us, about 42% market share and one that is fast growing, I'd like to believe that, and SIP being the retail and sticky business, over a period of time, the 35% should expand closer to 40% in the next 2 to 3 years.
All right, market share going to 40% in the next 2 to 3 years. Shrikant, we've spoken about business enough, but both Nigel and I had a question, and I'm sure you've been asked this a lot of times.
And I think you know it as well.
Are you related to the other Mr. Famous Nadella by any chance? I mean, that's a pretty, obvious question, I guess.
It is an obvious question, but no, I'm not. And hopefully, another Nadella will make his mark in the global economy one of these days.
Oh, damn.
Absolutely.
I thought you would say, yes, you are, and, both of your brothers, etc., or something. That would have added some...
But is there some background? I mean, similar place of origin or something like that? Something common in that?
Yes. We both belong to the city of Hyderabad, and, same, city and village I'd like to live, yeah.
All right, we're just trying to figure, if there's any famous D'Souza or Malu that we know of.
Tell me, I would love to know.
But the only other famous Mangalam I know is Kumar Mangalam Birla. Nothing to do with that. All right, Shrikant, thank you so much for joining in. Pleasure, as always, speaking with you. With that, we'll step into a short break, come back. We focus on the markets and individual stocks on the other side. The recovery on the Nifty from the lows is led by 3 stocks. The first one, of course, is ICICI Bank, which has recovered a good 0.8% from the lows. So doing well, virtually closer to the higher end of today's trading range. The other one is L&T. That one's seen a bigger recovery, but as compared to ICICI Bank, has a slightly softer weight on the index, but it is an index heavyweight nevertheless. And the third one comes in from Titan, which has moved to the high point of trade. This morning, there was a note coming in from Goldman Sachs, which was positive on the prospects of the business going forward. So that is having its weight on the performance of the stock today as well. So these are a couple of stocks which are doing well, but by and large, we are still sitting with a cut of around 75 points on the Nifty. The mid-cap index doing much worse. For everything else on the markets, let's take a short break, come back and leave it to the team of Trading Hour as we run out of time on this edition of Chartbusters. Thank you for watching.